How are you?
I'm doing well. I'm doing well. What's on my mind? Well, I am definitely following the SBF trial.
Are you?
That is, I'd say, number one on my mind right now.
Is it the rubbernecking instinct at work here? Like, what's the what's the emotional satisfaction you're deriving or anticipating when you make the decision to consume that content?
Yeah, good question. I would say it's probably that kind of wanting to see a train wreck. Um, I was intrigued by his prior interviews and I mean, I think he's at the forefront and the center of a crypto collapse because of fraud and embezzlement. And I think it's justice will be served, is my guess. And so I want to kind of follow along enough to make sure that it's being handled well and see if there's new information that comes to light, which I think will be interesting to see as the
What
case
have you
unfolds.
what have you learned? What are some of the highlights?
So, I think we're in day two of the trial, so it's still early. The jury has been selected. I think one thing is clear: most folks who haven't tried a case in front of a jury have a lot of opinions and not a lot of knowledge about what they're saying.
And Justin, you were a former litigator, so you have an
Yes, I
informed
am, and I have
perspective.
tried jury trials. I've tried bench trials.
Oh, this is
So
exciting. We're gonna get to the Martin Shkreli thread in a moment too.
yeah,
So,
that's a good one, a ridiculous one. I think it's so talking about the jury, it's really hard to know who is going to vote in which direction by looking at them, especially if you're not an expert in this area. I mean, there are trial experts who are paid handsome sums to help you select a jury and model what types of jurors you're looking for and why. They don't always get it right. And there's a whole cottage industry around that, which I'm sure was employed by both. I mean, usually deeper pocketed defendants have a better chance at utilizing those kind of consultants to help them in
well,
jury
SBF has
selection.
deep pockets, so he probably availed himself of those services.
I would think so.
Right.
This is bet the life litigation.
Right. Well,
I
it's
mean,
also his customers had deep pockets, therefore he has deep pockets because it's fraud.
I think you're presuming then that he's guilty, right?
Yeah, yeah,
Which
that's
I
right.
am as well. I mean, I won't go to presume. I will. I'm a fan of our constitutional system and the right to a jury trial and innocent until proven guilty. Um, I probably wouldn't make a good juror on this if I had been voir dire because I am pretty biased based on what I've read and what I know about the industry and what I've heard about him from folks who've interacted with him, investors who looked at, pitch decks and had discussions with their team around investing. And, you know, it sounded like an absolute shit show from the beginning.
So, what are some of the takeaways then from your learnings about the trial? I've been listening to the Laura Shin. She's got a 4 minute daily summary, so I get my quick itch/fix through that.
Yeah. So I think one thing, and this is an assumption on my part, but typically you don't know who are the alternates on the jury, right? And for good reason. And jurors themselves shouldn't know who are the alternates. I haven't seen like analysis to suggest that it's clear in this picture, but I've seen some people say, hey, here are the 12 jurors. Maybe that's the case, and maybe the six alternates and everybody knows who are the alternates. Usually you don't, so that the
Mhm.
alternates are paying just as much attention to the trial so that if they are called in the end to vote that they haven't napped during trial. But
Mhm.
it's 11 women and 7 men out of the 12 jurors plus six alternates. I think that I thought it was interesting how the prosecution started off their case in terms of who they're calling as witnesses. So two of their witnesses have been, one was a person who lost $100,000 in FTX because they left their money in after SBF tweeted that everything was going to be fine, and
Right.
multiple Bitcoins got trapped. And then one of Sam Bankman-Fried's friends and an engineer who coded up some of the infrastructure and backend, and said that he quit in November and asked, why did you quit? Well, because Alameda had taken FTX customer deposits to pay back creditors, and I thought I might have built the code that gave them the access to it.
He built the backdoor.
Yeah. So they went right for it to set the tone, which is what you do, right? They went right to the heart of the case, which is when people lost money, and coders who were his friends built this system, and it was designed to do exactly what it did.
And it was clear and direct language from the prosecutors. SBF is lying. He stole from customers. Whereas SBF's legal team was continuing to use these word salads and technical jargon to confuse what seems like a salt of the earth jury who doesn't understand that.
Yeah. So, again, those are opening statements, right? So opening statements are, I think the judge called them movie trailers, which I hadn't heard that phrase before from a judge, but I like that. It's just a preview of what you're going to see. And, ultimately the prosecution is going to have to prove what they have stated in opening as what they will prove, right? So we'll see whether they can bring the proof. I think that you're onto something, though, around the way SBF's attorneys have approached this and will approach this. And there's been some commentary, particularly in the crypto world, that crypto's complicated, and it's we don't understand, and a lot of people don't understand, what does cryptocurrency mean. Maybe some of the underlying issues or the kind of digital nature of the asset is challenging for some to comprehend. Yet, I think that is the angle the defense wants to use to make this appear that there were some legitimate crypto-based reasons for the structure that was created, and that it wasn't just fraud and theft. Because at bottom, it doesn't matter what the underlying purchases were by customers. They could have been purchasing, anything that they had a right to redeem for cash value, and then that cash was dissipated. It happens that they were buying crypto. It happens that they were getting a lot of FTX native tokens that were being manipulated. But at the end of the day, they were buying something that needed to be redeemable for a certain corresponding dollar amount, and that underlying money was just taken.
Right. So, the technology doesn't change the facts and the legal analysis here. There was an interesting statement where the defense lawyer said, building a startup is like flying a jet, but you're building a jet. But then they with essential, and therefore SBF had no idea what was going on. It's like, no, that's not true. So if you're building a startup, an operator, you're refactoring your business, and you know where to focus, and you know what the issues are, because you are responsible. So that defense, I don't think, will be terribly effective, although the defense will really turn, as you pointed out, on what the facts are. It's not about whether SBF was checked out or not. He's responsible.
Right. I think that defense will fall flat. I think it's laughable that that's their approach, which to me means they have very little support. I think if they were facing a negligence claim, that would be a wonderful defense. Hey, look, we're building a startup. We're building a plane as we're flying it. Was there some bad code out there? Yes. We didn't know it. It had unintended consequences. You can't hold us to a certain standard and say that we intentionally did these things. They happened by accident, right?
But they don't
that
have
amount of money doesn't disappear by accident and turn into private jets and $30 million homes and Tom Brady and Gisele Bündchen ads on TV. Like, come on.
Right. Should be very interesting. I also found interesting that Sam's leg is no longer twitching. And of course, in prison, it's been reported he doesn't have access to the medications that he was on previously, my understanding. So maybe there's some causality there, but for some reason I found that fact interesting.
Oh, I heard different reporting. I heard that his leg was
That's still
twitching
twitching.
under the desk a
We need a
lot.
leg twitch indicator.
Yeah, it was funny that the reporters are talking about those kinds of things, and who knows what's true or false. I haven't seen like video.
Someone's watching his leg. Like, is that thing twitching?
Yeah. One thing I did notice and read was that he has, a tighter haircut and a more buttoned up appearance, which I think is good, right? He kind of looked like a slob. And if you're trying to say, I didn't steal a bunch of money and I wasn't careless and reckless with customer deposits, you probably want to look a little better than he used to look.
Well, you don't want to look too pretty, right? I think Martin Shkreli's advice.
I don't think he has that worry. I don't think he's going to look too pretty.
I think Martin said, he gave him some advice on the Unchained podcast. Said, I think he said, Sam, you're supposed to shave your head. So clearly he hasn't done that yet. So what else? Anything else on the SBF topic?
I wouldn't take advice from Martin Shkreli if I was.
So you don't think his jury analysis? So Prego, and I'm just going to pull up the thread here quickly and share it on the screen. Yeah.
You're going to take
really funny thread.
If you're going to take advice from someone, take advice from someone who beat charges, not who spent time in jail.
Ooh, that's a good zinger there. Yeah. By the way, are those strategies to hire consultants to vet jurors, are those historically effective? Or is it very subjective and people spend money on them anyway because there's some lore that maybe it's effective?
I haven't seen data analytics to determine whether, they are or are not effective. I would imagine that they are effective if you have sufficient time during voir dire to get a set of questions and a feel of the potential jurors, and you have a psychological profile of what you want on that jury. And so I would believe that they are effective. Now, it's probably at the margins, right? You're not going to be able to move somebody from absolutely guilty with no evidentiary support in their defense to innocent. But,
right.
Well,
there you have it. That's from a former litigator who's gone through the jury interview, voir dire process, and handled trials. So don't put too much stock in the Shkreli analysis, although it's really funny.
It is funny. It's funny that he's like, hey, you got hope on this one juror. Focus on that.
Like juror. Any random jury would have a distribution of occupations that would likely resemble something like the list we just saw also. Right. Right. It's just called America, right? That's what people do in America.
That's the point of the jury system, right? It's a jury of your peers. You're supposed to have a representative cross-section of the jurisdiction in which you're being tried. So
right on. What else should we talk about?
Well, I would love to hear from you what's on your mind. I know you've been talking a little bit about some emerging market opportunities and looking at a fair number of other interesting things.
Yeah, we've been focused on several managers we like in private credit, but we're sourcing more. And the question there is, how do you invest in private credit, but manage the tax, because it's taxed, interest income is taxed at ordinary income tax rate. So if you live in California and Florida, then federal and state tax together from the higher marginal tax rate is painful. So these strategies can generate 16 to 18% pre-tax returns. That's why endowments and pensions like that. That's why Harvard Management Company likes that. But if you're a U.S. taxable investor, then your after-tax returns could be half of that, which still isn't bad. It beats treasuries. So been thinking about that. And the other topic been focused on is sourcing crypto venture investors. So most of this year, our focus in digital assets has been around these discount to NAV trades and ETH in particular, betting on the thesis that these discounts will close because the ETS will be approved. Now, looking ahead as we start to advance in the market, I believe the higher return opportunities are an early stage crypto venture. There are hundreds of crypto venture firms, and there's so many themes and so many approaches that they take. Whether it's,
So do you like emerging managers or do you like more established managers, and why?
yeah, first off, great question. Yeah, I prefer emerging managers, not fund one. Fund one, you learn, you make mistakes. And the large managers are increasingly becoming asset gatherers, meaning they make money on their management fees less than performance fees. And it shows in the returns. And there's a great post from Nick, who's a VC at One Confirmation. He was an investor in OpenSea. He's a VC that invests in crypto native projects only. Okay. And he posted his returns. I think it was like 4x or 5x a distribution on paid in capital rather than an unrealized mark, which is very important in today's world. Distributions, we eat distributions. We don't eat marks. Cash matters. And his point, he was calling out, he didn't name any managers, but he's calling out the larger institutional, not institutional, might be the wrong word. These guys are institutional, I would say, but much larger funds that have a lot more money to put to work and maybe are more seasoned. And his point is that they generate lower returns, and that's true. So yes, I prefer the emerging managers.
Yeah, I would imagine higher risk with emerging managers, lower track record, so your variance of outcomes is going to be greater.
I wouldn't necessarily say higher risk with emerging managers. So there's different kinds of risks, right? So if a platform has enough capital to fund the GP and the operations and the diligence, and they can source and compete for deals, they have the right analysis in the docs and vetting, then that operational risk isn't there. They're still institutional grade, right? Are there risks from other factors? Sure, but we don't want to take risk of can they execute and operate kind of risk. So some of those risks are in fund one. But no, it's an interesting category. Like there's a Dragonfly did well with Aptos. So Aptos may well have returned the fund for Dragonfly. But some venture funds write checks at much higher valuations.
Right.
Aptos was a very high valuation. It was like a Facebook DM spinoff team. As a layer one thesis, layer one and infrastructure themes are generally much higher valuations. So the returns you get as an investor are going to, on average, be lower, but it depends on different scenarios. I invested in L1 Advisors at a much lower valuation. I'm not going to show the valuation. I would say it's a fairly priced valuations for the entrepreneur as well as for the investor.
Yeah. Well, that's good. And what else is on your mind these days?
What else? So on the private credit side, we're spending a lot of time on tax. So there's all the rage is around private credit right now because the banks are pulling back. They're $1.5 trillion in AUM flowing into that. Blackstone, Apollo, KKR have joined the S&P 500, and they are raising money against private credit, which is really funny because those are private equity firms, not private credit firms. They're pivoting the focus of their business model. So where we've been spending time is how do we think about this tax efficiently, right? So there's a lot of clever tax structuring approaches one can take. I'll summarize a few briefly and feel free to chime in, Justin. I know you and I have been kicking the tires around this, but one is, for example, a private credit fund generates passive income on your K1 and depreciation from commercial real estate generates passive losses. We want passive losses. It's one of the virtues of owning real estate. You get to depreciate your investment purchase, unlike when you buy a house that you live in. You cannot depreciate that purchase against your income. So what's the right balance of these investments that throw off valuable passive losses, depreciation expense that we can use to offset the passive income from a taxable private credit strategy. So that's been super interesting. And also, we've been talking about private placement life insurance. We should have a session on that at some point. But the ability to use life insurance, borrow against your life insurance policy, you're paying interest to yourself, and have the cash value of the life insurance grow tax efficiently because it's a life insurance vehicle as opposed to being a part of your taxable estate. These are the strategies, of course, that high net worth, ultra net worth investors employ and take advantage of to compound wealth and improve their risk adjusted returns.
Yeah, no, those sophisticated strategies are very, very interesting, complicated, so simple, not easy to implement, but can deliver really outsized like after tax returns for investors.
Right. I look forward to sharing more kind of behind the veil around how all of that works and how do you link that investing with the tax mitigation and minimizing the taxable estate as well. There's a lot one can do around this.
That there is. Anything else you've been thinking about?
I think those are mainly my highlights. Oh, here's another quick thought for you. I did this post briefly the other day. I said the most rational investors in private markets, like the best investors in private markets, are highly rational. They're also the worst investors in public markets. And let me explain what I mean by that. So in private markets, you have to find reasons to say no quickly. You've got to look for not just obvious risks, but non-obvious risks, right? So you're looking at things like TAM, competition, the whole, what if Google does this, valuation, their go-to-market, and it takes a lot of critical analysis. And in public markets, it's very different. I'll give you a quick example. There is a factor you can look at called the negative EPS torpedo factor. It's a really colorful factor. Merrill Lynch has this factor. It's a factor that captures businesses that are experiencing declining earnings growth. They're in deterioration. They're in decline. Think of like a fundamental stock screener with just flip everything to the negative. Instead of growing profit margin, you have negative profit margin, etc. But that factor will actually generate returns from seasons. And one of the reasons why is because of the existence of private equity and M&A and management turnaround. So those kinds of interventions can happen in public markets. It's very difficult sometimes that to happen in private markets. There's less assets to finance, for example. So that was a thought there. Look, there are a lot of skillful private market investors that in my conversations with them, when I talk about public markets, I noticed that they're concerned about the Ukraine war. They're concerned about China and Taiwan. They're concerned about debt to GDP. And yes, our concerns, but markets do climb a wall of worry and markets do price in risks. So that was the general observation.
That's interesting. Yeah, I mean, in my experience, the skill set required to be successful in private investing is very different than public investing. So I agree with the kind of central thesis that you're putting forward. I also think we probably have, there's a major survivor bias in what gets discussed and cited. And so people who, all things equal, had a good underwriting and got lucky on an investment or a team get the, publicity, and then all of a sudden they have the Midas touch. It's not to suggest that luck is everything, but there's a lot of things that have to take place to take a startup from an idea to a publicly traded company or an acquisition. And, every one of those things has to go right. And, so therefore the likelihood of success is a coin flip because you're trying to string together, 5-6 things that have even if you stack the deck in your favor and say it's a 90% chance of success, well, but each one of them has to have that.
Well, there's a name for that. Of course, it's called a parlay bet, right? In horse betting, I think they call it the trifecta. And the payouts are high, but the risk is high. And, outside looking in, it seems like a low risk. Say, oh, what's the probability that it gets an exit? Well, that's one probability. But of course, to your point, there is, can they raise financing? If no, you're multiplying by 0. Can they sell to customers? Can they attract a high quality team? Can they execute? Those are 5 probabilities, and none of those probabilities are 100%. So if you take a number, let's say you have an 80% edge on all of those numbers. 0.8. Hey Google, what's 0.8 raised to the 5th power?
It's going to be like 0.3 something.
The answer is approximately 0.33.
There you go. Good math. 0. So 33%. That's if you're an 80% probability in each one. I think that is too high a probability to assume as well.
Right. So that's why in some ways venture investing, when you succeed, like did you have the Midas touch? Did you succeed, or did you get lucky? That's why you have to have enough bets in private investing to return the fund, right? You only need one outsized win to return the fund.
Luck matters a lot. Timing might be the most important factor in successful venture investing. I think, who said this? It was the NYU professor of valuations, like a legend, Damadoran. And he said, it's not that venture investors are great at spotting disruptive trends. In fact, they've missed a lot of things, like 3D printing could go on. It's that they're good at trading trends or timing and getting out. It's a really interesting take on it. But yeah, I agree. Luck matters a lot. There's clearly skill. I would bet on some of the VCs we've interviewed here. They've got a track record. They've got the performance. They've got the alignment. They've got a machine. There is skill in venture. And if you're unskilled in venture, and there's a lot of unskilled venture investors who, this is the flip side, they got lucky and everything go up into the right environment.
Sure.
And distinguishing between those two groups is difficult.
Yeah.
I think for an outsider to the category.
And I also don't want luck to be viewed necessarily pejoratively, right? You make your own luck. So doing the right diligence, understanding what those variables are to success doesn't mean that they will be successful. But if you analyze it well enough, put out enough bets, invest in the right teams, the right trends, the right inflection points in society or technology, then the likelihood of having one of those outsized returns increases.
We'll have to talk about venture more. Here's actually reminded me of another topic that came up. So another theme I've been seeing in venture is that venture funds, are launching extension rounds, right? So imagine you're an early stage investor, you've deployed to 20 or 30 firms, and I have a new fund, the purpose of which is to pick 5 to 10 portcos in the earlier fund, and that's the only thing they do. And I think it's a disaster, because are they going to pick the best ones, whatever that means? Are they going to pick the ones that just need a little bit more capital to test whether their thesis works? Are they picking the safest ones that have traction? Those are all different objectives. And can they even pick those? It's very difficult to actually identify where you want to double down. And it's really a sign of distress in the venture market. There's still a lot of pain that's coming. We're starting to see some venture funds shutter. Some venture funds will do exceptionally well, and we seek to identify what those venture firms will be. But there's a lot of pain in venture to come, and recaps and down rounds and hard conversations.
Yeah. Valuation. That's the challenge. Everything was up and to the right for years. Firms invested, chased deals, valuations were high, and these extension rounds are a result of difficulty attracting new capital at a higher valuation. Even a slight down round is probably difficult for some of these firms that its valuation just didn't make sense. And therefore currently makes very little sense.
Right.
So
Exactly. Look, we live in a risky world. We talked about all the ways a startup can fail. One of the factors in your control is your entry valuation. And in real estate, there's this expression, you make your money on the buy. Second, you grow the value through asset management. And then you focus on getting liquidity in the exit. But if you don't invest at an attractive price on the buy, there's not much you can do to dig out of the hole. There's only so much value asset management can create, or waiting for ideal exit conditions. So yeah, no, we're highly valuation sensitive. Justin knows I always talking about valuation.
that's right. I agree.
Should we call it a wrap there?
We should. That was a great conversation. I'm excited to continue tracking the SBF trial and give you more updates.
Looking forward to next time. Thank you. Have a good one.